What's up, YouTube? It's the Action Figure Grader coming back to you with another video. We're going to talk broad economy type stuff today, and we've done this a couple of times here recently. More data has come out that supports my belief, anyway, that a recession is coming within the U.S. I hope I'm wrong, but there's more and more rumblings from the people who know a lot more than I do that they all think a recession is coming. And they've done a survey here recently, which was the kind of the thumbnail topic for this video. They did a survey and of various Americans. It's kind of like I don't know what you want to call it, a statistically relevant sample of Americans across the country, asking them, do you think a recession is coming? And the results were overwhelmingly that Americans think a recession is coming. So we're going to dig into all that. We're going to dig into inverted yield curves, which I mentioned in the last video. And another major bank has recently projected that a recession is coming. They're the first to do it. So we're going to cover all that. Before I dig in any further, I want to say thank you to my Patreon supporters. You guys allow me to make more and different and better videos. I try to kind of span the gamut a little bit from everything for you where I usually cover, which is graded collectibles, to maybe broader topics like this that interest me. Some of you like it, some of you don't, and that's okay. You don't have to watch every video, but I wanted to kind of talk about what has been kind of popping up in the news this week. And I'm going to cover a number of different articles, mainly from CNBC, where I get most of my financial news. They're kind of a neutral, non-political viewpoint in terms of the financial markets, which I like. If you view things from a certain lens, whether you're left or right, oftentimes that information can be skewed. And my opinion is that when you look at the data from CNBC, most of that stuff is pretty reliable and it's non-political in nature. And that's kind of what I like to see when I talk about finance stuff. So inflation fears are forcing Americans to rethink their choices, and some really interesting stats popped out in this one. The Consumer Price Index jumped 7.9% in February. We already covered that. That's a huge jump, and it's weighing on people's minds. So they did an online survey, an online poll of 3,953 adults across the nation. And that's what's important about that is that's a pretty statistically relevant number. When you get to that large of a number, you're starting to get to regression model type numbers where you can start to think that those numbers are pretty statistically relevant, meaning that that sample is a pretty good idea of what's really going on in the country right now. And 48% of people said that they think about rising prices all the time. I hope that's not the case. I hope that half of our country aren't thinking about rising prices all the time. But you also have to remember that there's a lot of people out there that are living paycheck to paycheck right now, and rising prices hit them in the wallet a lot harder than maybe others of us that can afford some of this inflation. There's a lot of people that are living paycheck to paycheck and blue collar, and this high gas prices and high grocery bills, that really hurts them. It really hurts their wallet, and I can understand the concerns there. What was interesting here is inflation is costing the average U.S. household an additional $296 a month, according to Moody's Analytics. And Moody's is a very reliable kind of financial services firm. That is a big number. And experts expect that to get worse before it gets better. Not very surprising there. With all the supply chain logistics issues that we're having in our country, with the price of oil skyrocketing, although it has leveled out a little bit, everything that's going on overseas in Europe right now, $296 a month is the kind of what inflation is causing. And I see it in my own costs. Gas prices here locally have just gone through the roof. The biggest area where people are cutting back is dining out. And that's true for me. I've really cut that out quite a bit. 53% said they've cut out dining. That's a pretty big number. They're cutting back on driving. Almost 40% of people are. They've canceled a monthly subscription, 35%. So lots of different ways that people are cutting out costs right now. And at the end of the video, I'm going to give you 5 things that you should not do if you think a recession is coming. I think it's a really interesting article. And by the way, I'm going to put links to all of this information in the video description in case any of you want to look at these in more detail. But very, very interesting. data, and in the last year, gas prices have spiked 38%. Rent and costs of housing has gone up 5% almost. Food prices have increased 7.9%. So really big numbers in terms of inflation. The majority of Americans are concerned about an economic recession, with 81% believing that one is likely to happen this year. Not in 2023, but this year. People are definitely on edge, and recession risks are high. So very interesting there. The other thing, if you look at it from the other side of the view, the other kind of point of view, most economists right now don't think or are not concerned about a recession being on the near-term horizon. And I'm confused by that. You know, I think that they're looking only at the base numbers, and this is something we've talked about. The labor market right now, you'd be hard-pressed to find any indication of recession. And that's true. The labor market is really tight right now. There's a lot of open jobs available. There's a lot of people sitting on the sideline. We've had what's called the Great Resignation, where people are leaving their jobs because they're unhappy. So a lot of economists think that because the labor market is so hot, we can't possibly have a recession. And my argument is that because of inflation, the Fed is going to have to raise rates. They've already raised rates once, and they're already expected to raise rates even further. And as I talked about in my last video, once the interest rate yield curve goes inverted, that's usually a sign that recessions are going to happen. It's happened historically. We've looked at it in the last video about that, and how anytime the yield curve, almost every time the yield curve has gone inverted, a recession has happened. And what does that mean? Well, what that means is that typically a typical yield curve is the longer that you hold, like a treasury note, for example, a 10-year treasury note should give you a higher rate of return than a short-term note because you're holding it for longer. There's more inherent risk. There's more inherent hold time in terms of holding that treasury note. But right now, you're getting a higher rate of return on shorter-term bonds. And so if you look at it right now, the 10-year treasury rate is getting you 2.562%. Well, just the 2-year counterpart is 2.52, and right now that's gone up. It's gone up to 2.7%, and so that's actually more. A 5-year note is giving you a higher rate of return than a 30-year note, which is crazy. You should get a higher rate of return on the longer term note. And so what that means is that's an inverted yield curve, and it's not healthy. That's usually a bad sign that we're either in a high inflation environment, which we are, or people are expecting the Fed to raise rates, which they are. And so those two factors usually combine for an early warning sign that a recession is coming, because as the Fed raises rates, it puts a damper down on the economy because the cost of capital is higher for businesses that want to borrow to expand. Credit cards, any kind of adjustable rate mortgage, student loans, car debt, any of that stuff that's on an adjustable rate mortgage goes up. And as a result, the servicing of that debt cost goes up, which in turn lowers capital investment for businesses or for individuals. Individuals can no longer spend quite as much on services and on goods within the U.S. economy because they're servicing that existing debt load. So that's what the yield curve, an inverted yield curve, means. And it's a big concern right now because the yield curve has gone inverted, and it's expected to go further inverted as the Fed raises rates. They're expecting to raise rates another half a point in May, another half a point in June, and another half a point in July. So they really are ratcheting up rates. And as a result, there's been a 40% drop in applications for mortgages. That is a massive, massive drop in the number of people who are applying for mortgages right now. So people who are looking to get a loan for their home, first home, second home, whether they're changing homes, a 40% drop from a year ago is just a unheard of drop. And I think the last time we saw such a major drop was in the 07 or 08 Great Recession, when banks were failing, like Lehman Brothers, and Bear Stearns was another example of that. So the 30-year fixed rate mortgage which is the kind of the baseline that most people use for borrowing to buy a house, has skyrocketed because the Fed is raising the federal funds rate. And that 40% drop is kind of the early warning sign, so to speak, in my opinion, that a recession is going to come, because it's slowing everything down. It's just going to slow down the increase of prices. There's going to be less buyer demand for houses. So all these multiple offer type situations that we're dealing with right now, may slow down a little bit. And that's just a trickle down to everything else, whether it's real estate or any other kind of services. And as a result, Deutsche Bank, they just came out on Tuesday, April 5th, yesterday. I'm recording this on April 6th. Deutsche Bank is the first big bank to forecast a U.S. recession. So, this is kind of, I already talked about this a week or so ago, that I thought that a recession is already here, or if it's not, it's going to be here very soon. Well, Deutsche Bank is saying that beginning next year, they think that there's going to be a recession. I think that that's ridiculous. I think there's no way it's going to take as long as late next year, late 2023, for us to see a recession in the U.S. Maybe I'm wrong, and I hope I'm wrong, but I think we're going to see a recession much sooner. And there's potential, in my opinion, that we're already in a recession and we don't even know it yet. I mean, it's just with everything that's happening in terms of prices, people are tightening up already because they see the warning signs on the wall right now with high gas prices and high grocery bills. We just talked about that survey. And as consumer sentiment changes to the negative, it has a very, very rapid effect on the U.S. economy, because about 80% of the U.S. economy is just spending, goods and services spending. And as consumers become more fearful of a recession, it has a trickle-down effect, and then very quickly the cogs, the gears that grind within the U.S. economy come to a halt. So while I think that Deutsche Bank, being the first big investment bank to make the call that a recession's coming, I don't know if it's necessarily, to me, this is like, congrats, Captain Obvious, welcome to the party. The rest of us already know this is happening. And I also think that this forecast of it being late next year is way late. It's maybe late this year, I think, could be the latest that we start to see the first signs of a recession. And, again, I could be wrong just because the labor market's so strong, but with interest rates doing what they're doing, with everything that's happening globally in the geopolitical landscape, with the war overseas in Europe, and then the inflation fears, all of that stuff's going to combine, I think, to cause major problems. Goldman Sachs, as we talked about already, there are experts out there taking the other side of the coin. Some of those economists that I mentioned earlier in this video that says, I don't really see the signs of the warning signs of a recession in the U.S. because the labor market's so strong. Well, Goldman Sachs said, no, the chances of a recession in 2022 are at 35%. And again, I think that's low. I think that's a low number. Larry Summers, who was the Treasury Secretary under Clinton, he said that, he conducted some research at Harvard, and he said that when you combine overheating conditions of high inflation combined with low unemployment, that's usually followed in short order by a recession, because the Fed has to raise rates. When you have the massive inflation we're having, they have to raise rates really aggressively, and that's what they're doing. They've already done a 0.5 point, and they're projecting 0.5 point raises over the next 3 months consecutively. 0.5 point, 0.5 point, 0.5 point. Those are big jumps in the relative scheme of things. And I know that some of you don't agree with that. That's okay. You don't have to agree with me. I'm just saying that, in my opinion, based on recent history, it seems like the conditions are being set up perfectly for a pretty rapid change from an overheated economy into a recession. So we'll see if it happens or not. Now, 5 things that you shouldn't do during a recession. And I think these are worth talking about. I'm not trying to be your financial advisor, but these are 5 things that I personally am kind of implementing myself just in the event that we could potentially hit a recession. Becoming a co-signer on a loan. That's a very risky proposition right now. I like to buy rental property. I've bought rental property over the years and get them rented out to tenants and things like that. I am not in the market to buy another rental property right now because, number one, real estate prices are high. The times where I've done the best in terms of buying rental property, it's always been after the recession. So like we had that big 07, 08, 09 recession. Right after that, I bought 2 rental properties and they've tripled in value since then. So Me personally, I'm not becoming a co-signer on any additional loans between now and the next recession. So that's a big one. The other one is kind of related to that, getting an adjustable rate mortgage. Why would you not want to get an adjustable rate mortgage right now? And also, I'll expand that to not just say adjustable rate mortgage. To the extent you can avoid credit card debt or any additional student loan debt or any new adjustable loan related to a car or a vehicle, avoid it right now if you can, because adjustable rate mortgages are going to go up, and anything that has an adjustable rate note is going to go up. Because why? The Fed is raising rates. So as they raise rates, it trickles down to every single other adjustable rate kind of mortgage or credit arm or any kind of flexible financing that has an adjustable rate. It's going to go up. So avoid that to the best you can. And again, it's the same kind of concept. The next one is to assume new debt. Try to avoid taking on any new debt. I'm personally in debt pay down mode right now. So any new debt, like last year, I spent a lot of money that I got, any kind of extra income that I could pull together. I paid down debt instead of taking on new debt. I think that's a great idea right now in a recessionary environment or a high risk recessionary environment. This is a good one. A lot of people don't think about, but taking your job for granted. And I think there are a lot of people doing that right now. We've talked about the great resignation that's going on in this country right now. A lot of people are quitting their jobs without any new job lined up. I don't know if I'd necessarily do that right now. Whether you hate your job or not, to me, hold on to your job until you get through the next recession. That's my personal opinion on that. Obviously you got to do what you got to do in terms of your personal lifestyle and your lifestyle choices. But for me, I don't take my job for granted right now, because I can tell you, I'm in real estate. We don't have a fixed income. Everything's tied to making transactions happen. I'm an independent contractor. I own my own business. And I can tell you that the next recession will hit my business hard. It's a very high reward, but low payoff type of job in a recessionary environment. That during the last great recession in 07 or 08, I wasn't making a lot of money, and I got really, really good at Xbox games because I had a lot of dead time. I just wasn't making any money, and we made it through it, but it was not fun. And I don't take my job for granted. I don't take any income I make right now for granted, because I know that the next economic slowdown is going to come sooner rather than later, and I got to be prepared for it. So another good one, or the last one, is making risky investments. This is a really important thing right now. I personally would not be buying a rocket-firing Boba Fett for $200,000 and taking out a second mortgage on my home to buy that right now. It's just a really risky time, I think, within our U.S. economy. And if your job is at all tied or at all kind of affected by a recession, there's some jobs out there that are recession-proof. My wife's got a good example. She's got a job where it's not really affected by recessions. And that's good. That's good for us as a family. But my job it's highly dependent on how good the economy is doing. And if you have a job like mine where the next recession will hit you pretty hard in the wallet, you don't want to be making any risky investments right now. So again, I'll put all of the links to all these articles in the description for this video, because I do think there's some really good information in here and food for thought as our economy sits on kind of an inflection point. And I think we got a recession coming. I hope I'm wrong, but all the data and all the warning signs are out there, and there are more and more experts who are starting to agree with me on that. If you like this video, please consider subscribing if you're new to the channel. As always, to my existing subscribers, thanks so much for watching, and I'll be back soon.